My name's Nick Walton. I'm a portfolio manager with First National Wealth Management. The big challenge lately is 2023 was a fantastic year in the stock markets. A lot of that return came from a very concentrated portion of the market. Most of it was in the large cap growth space, specifically 7 stocks that are commonly referred to as the Magnificent Seven. While it was great for overall portfolio returns, the big challenge is that folks tend to remember, what have you done for me lately? And they forget that in 2022, a lot of those 7 stocks were some of the biggest stocks that were driving the market down. So the conversations we've been having are really keeping folks focused on the fact that it's important to own lots of different areas of the market. We definitely want to participate in those large cap growth stocks, which tend to be more technology. A really well diversified portfolio, you need the large cap value stocks. You need exposure to mid cap, small cap. You need exposure to international. A lot of the biggest companies in the world are not headquartered here in the US. You think about a lot of the products we use every day. We may think of them as American companies because they're products we buy at a local grocery store. They're products we use daily, but those particular companies aren't headquartered here. So it's in really this global world, it's important to have diversification on both the domestic side and international as well. So when we meet with clients, the first thing we want to come up with is really an asset allocation. A lot of that's going to be driven by the results of a financial plan, which help indicate which allocation might be appropriate for them. Then within that asset allocation is where we want to focus on the diversification. So the asset allocation is going to give us an idea, what do we want for exposure to stocks, which are really going to be your growth engine. Those are what help you outpace inflation so that your purchasing power continues to grow. If you think about $1 today, it goes a lot less further than it did 20 years ago. And if you think about how far $1 is going to go 20 years from today, it's reasonable to assume it's not going to go as far. So we think about stocks as that driver to help your purchasing power maintain pace with inflation over time. But it's also important to have fixed income. Fixed income provides stability. And as the name implies, fixed income kicks off income. So you do want fixed income in the short term for stability and meet current spending needs. And you need that stock exposure in there for long-term growth. We look at all the client's assets. The financial plan will even look at assets we don't hold here at the firm. It'll look at things like real estate. It'll look at hard assets. It might look at a 401k plan that they're not able to move to us because it has to be kept at the current company. So it's really more of a holistic approach. But the asset allocation that we deal with is really going to be a result of what that plan tells us. And then within that asset allocation is when we start thinking about diversification. So we want exposure to lots of different areas of the market, large cap stocks, small cap stocks, mid cap stocks. We want value, we want growth. Because there's certain stocks that are going to do well at different periods of time. We're coming off 2023. The technology stocks did phenomenal, but in 2022 they didn't. You had an area like 2020 where a lot of your energy stocks, for example, didn't participate because people weren't traveling, they weren't using a lot of energy. So those stocks have recovered really well since the lows in 2020. So it's important to keep portfolios fully diversified. And we don't make any market calls. We're not market timers. Market timing is more luck than skill. In fact, it's no skill at all. Market timing is all luck. So what we do is ongoing rebalancing. So when you have a year like 2023, tech stocks do really well, we rebalance the portfolios. And that's really forcing us to trim some of those gains, not get out of the position, but trim some of those gains, come back to the portfolio's target weight. Then we're locking in those gains and we're redeploying to other areas of the market that may have been a little bit out of favor. Fantastic companies, but for whatever reason, out of favor. So we're buying them when they're a little bit cheap. So rebalancing forces you to sell high and buy low. We look at the diversification on equity and fixed income as well. Very similar process on the fixed income side. Cash isn't really going to be a tactical piece of the portfolio over the long term. Cash is really more of a short-term funding, short-term goals. So we do take into account cash needs. Oftentimes, though, cash positions in our portfolios are fairly small. We encourage folks, if they do have short-term needs, anything less than a year, it's usually going to be better served in a deposit account on the bank side.